Let's talk about growing wealth and the strategies that work. Now, in order to discuss growing wealth, we first have to have a clear definition of what wealth is, then discuss the purpose of that wealth. In easy terms, wealth is margin. Or said another way, wealth is the money you don't spend. If you make $500,000 a year, but spend all of it on your lifestyle, you have no wealth, you just have a lot of stuff. And it may be nice stuff, and it may satisfy your desire for your lifestyle, but it isn't wealth. Now, you might argue that stuff is an investment. Well, only if A, it appreciates in value, and B, you're willing to liquidate it when necessary or required by life circumstances. Now, on the other hand, if you make $50,000 a year and live on $30,000, then you have wealth. You might not have as much nice stuff, and you might be sacrificing your short-term desires for the long term, but you do have wealth. So if wealth is defined as margin, you grow wealth by spending less than you earn and doing that for a long period of time. So determine how much is enough. What is the finish line? Where are you content? What is the lowest level of lifestyle you can reach without feeling like you're lacking? Everything above that is wealth. And once you have wealth, you need to have a purpose for it. Purpose will help define the necessary amount of wealth, how it's allocated, and then that purpose balances your emotions when there are storm clouds. So here's a few examples. Let's say that the purpose of your wealth is to plan for the unknowns in life. Well, that defines your amount. How many months of lifestyle do you need to stockpile? Do you feel confident that if you lost your income, you could cut spending or work part-time, receive unemployment, whatever else you may do to allow you to have 3 months set aside? Or do you need 6 months? And once you determine that and that amount is defined, your purpose then dictates that this bucket of wealth prioritizes accessibility over growth. You need to allocate it in a way to be fully liquid, which means not only that you can get it easily, but you don't risk the value having dropped drastically when you need it. Well, how does this dictate your emotions? Well, knowing that you have these funds and that you can immediately access them and that they will be of at least the same value at which they began, you now have confidence against the curveballs in life. Well, that was preparing for the unknown. How about the known? Home, college, vacation, planning for the day when you no longer have an earned income. Well, how does that help with the amount? Well, that could easily be defined by having a customized financial plan. And then the allocation. Well, your time frame determines your allocation. Generally speaking, if the known event is in the next 3 years, it should remain in easily accessible risk-free accounts. If your known event is in the next 3 to 5 years, perhaps you can tolerate a little fluctuation, but you need to be insulated from the drastic movements in financial markets. If your time frame is 5 to 10 years, you can withstand a more balanced approach to risk management. If greater than 10 years, you can really focus on growth. And if it's greater than 15 years out, you can, if it suits your personality, focus on more aggressive or speculative growth. But how does your purpose help your emotion? Well, that's controlled by your good decisions and disciplined execution of your plan. If the money in your 15-plus bucket has a bad year, you don't have to sweat it and run the risk of making a harmful knee-jerk reaction. You know it's just fine where it is for right now. And when discussing these allocations, it's also important to understand that generally, when we discuss the more conservative approach, that'll consist of more bond or income type investments than stock or growth. And the more risk you're taking, it begins to shift towards those growth investments. But a good advisor knows that you can't only deal in black and white fact sets, but you must also understand the unique personality and risk tolerance of each investor. See, when you layer personality on top of this model of determining purpose and investing accordingly, you'll adjust. For example, if you have 2 investors in the 5 to 10 year bucket, one might be willing to experience a minimal level of fluctuation. Another individual may choose an investment that not only guarantees against loss, but also guarantees an interest rate greater than that could be received at a bank. Now, that same investor might want their 10 to 15 year money to have a guarantee against loss, but still have some potential to earn more than prevailing interest rates. And then in your 15 year bucket, one investor might want to really be aggressive. They could tolerate volatile fluctuation, but another might want to have some participation in the upside, but be willing to give up a little bit of that for a limited downside exposure. These all must be taken into consideration when building wealth and planning for long-term financial growth.